ladies and gentlemen, and welcome to the PIRAMAL Enterprises Limited Q4 and FY19 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hitesh Dhadda, Chief Investor Relations Officer from PIRAMAL Enterprises Limited. Thank you, and over to you, sir.
Thank you. Good evening, everyone. I'm pleased to welcome you all to this conference call to discuss Q4 and full year FY19 results. Our results material have been uploaded on our website, and you may like to download them and refer it during our discussion today. The discussion today may include some forward-looking statements, and these must be viewed in conjunction with the risk that our businesses face. On the call today, we have with us our Chairman, Mr. Ajay Piramal, Mr. Vijay Shah, our Executive Director, and Mr. Khushru Jijina, Managing Director of Financial Services Business. With that, I would like to hand it over to our Chairman and would request him to share his initial thoughts. Over to you, sir.
Thank you for taking part in our conference call. I want to begin by giving you an overview of the environment. Since September, we've seen that the macro environment has weakened. Financial services were hit by the IL&FS downgrade in September, which affected the NBFC sector the most. And it affected us in two ways: liquidity drying up, as well as that there was a mismatch in the ALMs of various companies. During this period, the RBI and government intervened to avert a major crisis, with the liquidity situation and borrowing costs easing from January 19 onwards. However, since January, some other adverse events and negative news continued to affect the microclimate. This was a time when we heard of SL, the ADAG group, JET, IL&FS, SPVs, DHFL. As such, NBFCs have limited exposure to these names as compared to banks and other financial institutions, but were still affected. This weakened macro sentiment has resulted in banks and mutual funds reducing exposure to the NBFC sector and rating agencies turning overcautious. Consequences of this have been that by and large, funds have dried up for the NBFC sector, and very few NBFCs have been able to grow their loan book. In contrast, most NBFCs have resorted to portfolio sell-down to meet their obligations. It is in light of all these that I would like you to look at the results that we have posted. We have always been saying that those NBFCs which have a high capitalization, have high promoter stakes, have strong governance, conservative internal processes and systems, and have deep sectoral understanding would be the ones that would prosper. And this is what you would see in our results. In spite of the above environment, our loan book has grown by 34% during this year. Income from the financial services grew by 39% in the second half of FY19. We have also performed better than industry due to our focus on several of the key strategic priorities. During this period, we've also been able to raise significant funding from long-term sources, both within the country and globally. We believe that the NBFCs have a key role to play in the industry, and for this we have now outlined some of our strategic priorities. The first strategic priority that we have is to further diversify our borrowing mix. In the last 2 quarters, we have reduced our CP borrowings and shifted funding mix from more long-term sources of funds. We raised during this period 16,500 crores via NCDs and bank loans. We've raised 1,500 crores of 10-year money at 9.5% during the quarter. Our CP borrowings, which were 18,000 crores at the end of September, have now come down to 8,900 crores. The number of banks now lending to us are much larger. Also, insurance and pension funds contribute nearly 10% of our borrowing. High quality equity and credit from reputed global and domestic institutions like IFC, SBI, LIC, Goldman, and Credit Suisse are some of our partners. Each of them has conducted a detailed due diligence of our portfolio to their satisfaction prior to approvals. We also have several more proposals lined up. We've tied up nearly 1,500 crores in long-term funds from PSU institutions. We are raising Tier 2 capital of 1,000 crores in the next quarter. Our maiden ECB issuance should take place in the first quarter of the current year. We are also looking at raising dollar bonds after our ECB issue. Our other strategic priority is to increase our loan diversification. We have, as we said at the beginning of the year, we are diversifying our loan book to reduce the overall risk profile. The diversification from real estate into other corporates as well as to retail lending. Our wholesale RE exposure was reduced from 83% in March 2015 to 63% today. Our housing finance now forms 9% of the overall book, and this was started only 18 months ago. Going forward, housing finance and corporate lending will remain as the key drivers of growth. We've also had a strategic priority of reducing client concentration. And our single borrower limit, we have limited our single borrower exposure. With consolidation of RE lenders like us, it inevitably have to participate in large transactions, and we plan to co-invest with like-minded partners such as pension funds and foreign banks on large deals. Today, our largest exposure just forms 7% of, and all the others are much below 5%. We continue to maintain a healthy asset quality. On the last call, we had talked about the sensitivity analysis conducted on our real estate portfolio, testing it against hypothetical worst-case scenarios. We tested our portfolio on 4 factors: cash cover, construction status of projects, selling prices, and financial closure. And we found that for a small number of our deals, 18 to be precise, that may face challenges in the hypothetical worst-case scenario, some proactive measures need to be taken. I'm happy to report that we have made significant progress in addressing a majority of these cases. Out of these, 2 deals that were already declared as NPA have now been resolved, and we have been able to recover our money, which is 110 crores from this. We continue to maintain a healthy asset quality, and our gross NPA ratio remains below 1%. In line with our conservative philosophy, we maintain provisions of nearly 1.9% of our total loan book. We continue on our focus on delivering robust returns. We aim to deliver 18 to 20% ROE in future by generating additional fee income. I'll now come to the pharma business. The reason why we exited the domestic generics business in 2010 was that we saw that there was a likelihood of profitability in the domestic pharma business coming to under strain. Post that, since 2010, there are a few key trends which are shaping the market. As I said, the domestic branded generics business has slowed down due to pricing controls. The U.S. oral dosage generics underpricing pressure is also under pricing pressure due to buyers' consolidation. There are also regulatory concerns which Indian companies have faced with the US FDA, and the Indian consumer with spending has increased. Our strategy has been in line with these. We've first of all created a differentiated business model for sustained growth. We've expanded our presence in specialized areas including complex generics and in providing products and services for global pharma. We have maintained a strong focus on quality and compliance. We cleared 33 US FDA inspections, 143 other regulatory inspections, and 989 customer audits since 2011, and I'm happy to say that we've not had any closures because of this. We've also leveraged our integrated business model in the services business and have seen a significant increase in the order book. And we continue to improve profitability and the return profile. Our global pharma EBITDA has crossed 1,000 crores in the current year, and our EBITDA margin has improved to 23% in this year. Post Abbott, we also saw a need to be present in new age businesses, and we saw that the US will continue to maintain its global status on innovation. Hence, we invested in DRG, which is a confluence of data and the increasing spend on healthcare. This investment was made when the US dollar to the rupee was 52. We have now been investing in this business and now are seeing early signs of success with a revenue growth of 10%. To conclude, the company will continue to deliver on our shared strategic priorities, both for the financial services and pharma business.
Operator, we can go for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking your question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah. So firstly, in terms of the weakness which you highlighted, which is there in the real estate segment and maybe in the...
Operator, we can't hear the question.
Yeah. So, and when we look at the weakness which is there in the real estate market, and we highlighted that hypothetically in the worst case scenario, there could be 18 deals which could face challenges. What would be the quantum of the book, if you can just quantify that in terms of the overall exposure? And would 1.9% of the provisioning, so maybe what is the percentage of coverage besides the stage 2 and stage 3 are we carrying on this?
Yeah. So let me answer this question. First, let me answer your point on those 18 deals. And as we had said in the last call, that we tested all our deals into 4 hypothetical scenarios. So I'm just repeating it for the benefit of everybody. I think one was on the cash cover. So in other words, how do all of our deals stack up on the cash cover today vis-a-vis when they were approved on the IC? Second, which are the projects which are significantly delayed in construction, either for want of approval, etc. Third, will there be equity value left in any of our projects if all our projects today, the prices crashed by 20% today itself? And third, we wanted to test all the projects to see whether if, as on date, with the balance amount of construction funding available from us, and with the assumption of sales going forward of the developer for those projects, if only 30% of the sales happen compared to the assumption, will we be able to complete the project? Now, all 4 together cannot happen, but we tested it on all 4, and hypothetically, in fact, we shared with you, we came for an 18 deals, which amounted to 2,300 crores. So please mind it is not some stage 2, stage 3. Stage 3 obviously is included in that, which was anyway the 2 which we resolved. Now I'm getting into more granular details of this. So in fact, as Mr. Piramal mentioned, we have been able to resolve all the 18 ones in the last 3 months, and let me give you some granular also of that. So out of the 18 deals, what did we do? In the 8 deals, which were not NPA or stress deals, but we believe that can be stressed if we don't take action, we have already moved the projects. We actually got the stress developer to sell the project or do a JDA with a stronger developer. So that's what we did for 8 deals out of the 18 deals. In 3 deals, we asked for additional security so that our cash cover and security cover goes up. Alternatively, there were certain projects among the 3 deals where additional security was given. We forced, or I would say worked along with the developer to monetize those. So automatically cash came into the system as equity. So if you understand what I mean. So obviously the project became healthier. In the other 2 deals, there were another 2 deals where we got the promoter to infuse equity from his own sources. And in another 2, in 2 more deals, we actually got ourselves refinanced. And in 2 deals, we actually initiated legal action, which is where we come to the point of our NPA, which is the further 2 NPAs what we did. So those 2 deals were actually, one was in Noida. If you recollect, there was a deal of 3C, which was in Noida, sector 150. I'm sorry, sector 79, which was an NPA which was. Hello.
Sorry about that. So actually, there was a whole music played from the line of Kunal Shah.
Are you there? Yeah. Is Kunal there?
So Kunal has placed a call on hold. So should we move to the next question?
We go to the next one. No, you can't.
Yes.
Next question, please.
The next question is from the line of Vinod Jain from Quest Investment Advisors. Please go ahead.
Good evening, sir. At the outset, congratulations on the good set of numbers. My first question is, what is the reason for the sequential drop in quarterly profit? Hello?
Yeah. So quarter 3 for us, there is a significant contribution that comes from our DRG business, which has a very high quantum of billing in quarter 3. That's the reason the overall profits of quarter 3 versus quarter 4, sequentially you will see profits to be lower as compared to quarter 3. And this was a similar...
Very well. Very well. My second question is on a wider perspective, sir. we are increasingly having commutation problems in our cities. In this context, we are seeing the concept of transit-oriented urban development or transit-oriented development being touted as a solution for the urban congestion. What would be the Piramal view on this concept?
I think let's restrict to the performance of the quarter and the year. These are more general questions which we should take outside.
Very well, sir. That is all.
Thank you.
Thank you. A reminder to all the participants, if you wish to ask a question, please press star and 1. The next question is from the line of Shubhranshu Mishra from BOB Capital Markets. Please go ahead.
Hi, sir. Thank you for the opportunity. My first question is the 2,100 crores of exposure or loan book to the hospitality sector. I just want to understand how much of it is under construction and how much of it is operational at the moment, and how many projects in total have you lent out to?
So they are all stable operational projects.
Okay.
More in the form of LRDs, if you can, against the room rents.
Okay.
And how many projects? I think there are around 3 or 4.
3 or 4. So these are large ticket sizes in that case.
Yeah, but then there are also they were the most I would say the best performing hotels. For example, the West End in Gurgaon, the Marriott in Bangalore. So these are the type of the hotels.
Right. Sure, sir. My second question is with regards to the healthcare analytics business. We have had a currency depreciation of almost 8.5% in this particular fiscal year, and we have only seen a 10% growth in the revenue. So, is that 1.5% is the only growth rate, and how do we look at the market growth and margin expansion in that particular business?
Sorry, say it again. What did the question is? Just repeat the last part of the question, please.
So, how do we look at the underlying market growth in the healthcare analytics business and the scope for margin expansion going forward, sir? Or the strategy for margin?
We expect that the dollar growth should be in the region of between 5 to 7% in this space, and the margin will go up in the current year.
So, what is the strategy for the margin expansion, sir? Are we going to have more offshore business, delivery business, or how do we look at margin expansion?
So, we are increasing our exposure to our offshore exposure. So the number of people that we have now got in India is increasing, and we are also changing the product mix to see that our margin goes up. So in the current year, I expect the margins to be higher than what they were in the last year.
Any number that you would guide to, sir, in FY20?
It could be about 22%.
Sure, sir. Thank you for your time, sir.
Thank you. The next question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hi, good evening, everyone. First question is on your...
I'm sorry, Alpesh. May I request you to speak a little closer to the phone?
Is this audible now?
This is better, thank you.
Yeah, thanks. So the first question is on the gross NPA side. We have seen sequentially it is going up from 50 basis points to around 90 basis points. So can you just throw some light on the movement and the kind of accounts that slipped during the quarter?
Yeah, so but before I answer that, I need to, again repeat what we have been saying along, that at the end of the day, NPA is what is recognized after 90 days, but we have continuously shown the ability to turn it around. And let me then go into the granular details of your question. So for example, if you see in December 18, we had 2 accounts among the NPAs, which was, one was the 3C, which is Lotus, and another was Nirmal Lifestyle. Today, and as we had said on the December call, we have actually cured both of them because both the projects were sold off to another developer. In the current quarter, why did it go up? Because the other project of Lotus Green, which is Delhi 1 in Noida, which has gone in NCLT. But again, let me say this once again, that even this project having gone to in the NPA, it will be cured. at the end of the day, we are already working along with many people to cure it. So this is not going to be a loss. The other decision which we took was on Jain Heights, where we could have and actually whether it is Jain Heights or the one more which was a non-real estate one, which was in the emerging corporate lending in the lending of 61 crores to SK Group, which we have taken as NPA. What has really happened? And frankly, this should also be looked upon the way we have always been saying that we believe that if it is 90 days, we would cure it, we would not like to evergreen it. So what do I mean by that? Frankly, the overdue in SK Group was hardly a crore or two. But we decided that when we look at EWS and our processes, we believe that this account has to be cured holistically and not just for quarter on quarter. So while we speak on SK Group, I can tell you before June, we'll have a solution because the entire building, commercial building, which is mortgaged to us, is actually getting sold. As we speak, it is getting sold. So not only it will get out of NPA, our entire loan will come out. Coming to Jain Heights, it was one of the smaller accounts of Bangalore, and we realized that rather than spending too much time on it, why not take over the project and cure it? And that is why we took the whole thing as an NPA. And as we speak, all the three projects, we have segregated it, and we have a different action plan for that. And we'll keep on reporting on that, and you'll see the progress quarter on quarter on that also. So really, while it has gone up because of these three additions, I can assure you one thing, that all three are actually, as we speak, getting cured. So that is the reason why in this quarter you see this three addition, that's why it's gone to 0.9.
Okay, so what would be the quantum of these three accounts, and that 110 crores got upgraded or recovered in this quarter, or those were the accounts got recovered
during
the
it got recovered in this quarter itself.
Okay, and what would be the quantum of these three accounts which lived into the quarter?
So these three accounts, just give me 1 minute, I'm just doing an overall math. 382 crores.
Okay, so there are no write-offs per se during the quarter?
No.
Okay. Second question.
Repeating for the sake of repetition, these are being cured as we speak.
Sure. The second question is on the margin side. I believe the table that we report is on the cumulative numbers, right? So the yield and the cost data that we have reported is for the full financial year, not for the quarter.
That's for the full year.
Yeah. So if I look at the number for the 9 months versus the full year, it looks like on a sequential basis there has been quite a bit pressure on the margins, largely because of the rise in the cost of funds. And the cost of funds for the quarter, based on the derivation, works out to be roughly 10%. Is my understanding correct over here?
You are absolutely right. So in fact, as Mr. Piramal mentioned, our singular focus on raising long-term funds has been there. So that is one of the reasons where in the last quarter, slightly the cost went up. The other reason was also because in the month of March, along with our, as you know, I'll just talk about our strategic partnership also, which we've been talking about. So we have now entered into strategic partnership with foreign funds. So we in fact took some money from the foreign funds also, which we are now in the state of repayment. Already it has started in April, May, etc. And you will see this 10% actually starting to go down from April, May, June itself. So these are the two reasons. The other thing I must say that while the cost has increased, your point is right of 10%, but you will start seeing things going down because, as I said, that there are certain loans in March which we took to island ourselves because liquidity is much more important than even the rates today. But having said that, now we are in the process of starting to pay that, so you'll see the rates going down. The other thing is that on the asset side, we have started to see that the risk-adjusted returns coming back. So definitely we have actually, while you see it in the quarter an aberration, because of the high cost of funds, the NIMs have gone down. I can confirm to you that the NIMs of the 9 months which were there of 6.5% to 6.6% will be back in this quarter itself.
And your confidence is despite the shift in the portfolio mix, because we are moving towards more of retail portfolio. So wouldn't that put a pressure on margins?
No, I'll tell you why. Because I think if you really study the portfolio, what has really happened is that we have explained this, I think, in the last 2 quarters, that basically because of a lot of competition in the NBFC space, there was a lot of undercutting in the rates. So the risk-adjusted returns were not there. So today we are actually on the asset side, and you will see it in this quarter itself. The portfolio, the new assets which we are building, the lending which we are doing, are having the correct risk-adjusted returns. So that more than oversets the retail growth which we are doing. if I'm making sense to you.
And any target on this retail proportion by end of next year? Currently, we are at around 9%. So what would be the any ballpark number that would?
Yes. So I think we have already made that statement last time itself that around 15 to 18% of our book would be retail.
Okay. Another question.
On an organic basis.
Sure. And another question is, so at the end of last year, there were certain loans which were sitting on the standalone balance sheet, which were supposed to be transferred to the HFC business. Has that entire thing played out, or there is still something which is?
Yes. So out of the 10,000 crores, more than half were actually transferred, and the balance, as per our guidance, which we have already given to the Reserve Bank, will get over by this year. But just to tell you, 1,500 out of the 5,000 crores, which is pending, is getting out in this quarter.
Also 5,000 is still pending on the standalone balance sheet.
Yes, but that is as per the guidance we had already given to the Reserve Bank. So it's not some deviation we are doing.
Perfect. And one more question, just from a regulatory perspective. I believe 20% maximum exposure that is allowed for any specific developer would be 20% of the net owned funds, right? So our net owned funds are at around 11,000 crores on the HFC side. So the maximum exposure that we can have in that balance sheet would be around 2,200, 2,300 crores, whereas the largest developer is around 3,500 crores. So,
yes, so good
the balance
question.
would be sitting on the standalone balance sheet?
So let me address that. So in fact, last time when we spoke about Lodha, we were at 4,400 crores. I'm happy to report that today we are already at 3,800 crores. I would also be happy to tell you that we've already got 2 sanctions for downselling, and we'll be downselling in this next 2 months itself 1,000 crores. So in fact, in June itself, we'll be down to anywhere between 2,600 to 2,800 crores. So we are well on our path to be below 20% as per the commitment given to Reserve Bank.
Okay, and as of now, the additional exposure must be sitting on the standalone balance sheet, right?
Exactly. But I'm sure you are happy to note that we are accelerating it, in fact.
Agreed. And if I may squeeze in one more question, there has been some rating action towards your largest exposure. So any comment on that, and any comment on the London property sale that those guys were doing?
So I think, we have said this before and we'll say this again. I think first and foremost, I think if you look at our loan, I think we have said this, the last time also we shared with you that our actually loans have been prepaid 1 year in advance. I think the quality of the portfolio speaks. The fact that we are getting prepaid by them. Also, I just now shared with you that anywhere between 1,000 to 1,200 crores of downselling is happening in the next 2 months. Should speak about our underwriting and the quality of that portfolio. Otherwise, why would anybody take it? I think the action should speak rather than we explain. Coming to your point on the Lodha, on the London, from what we understand, not only they have a plan A, which I think the first tranche is coming by the end of April. They have reconfirmed that, but they actually have a plan B also in place, which is they have another bank to take over their long-term exposure in London. The third point is, which I'm sure you have to actually, it has to come from the Lodhas, but again we forget that they have a substantial commercial portfolio, which unfortunately nobody talks about. Everybody thinks of Lodha as a residential play. So they have a large portfolio of commercial leased out, which I think this year you will see a lot of action, maybe in terms of sale to investors, etc., bringing in liquidity to bring down their debt equity ratio.
Okay, and can I squeeze in one more question?
I think
I come back in the queue.
Yeah, you can join back in the queue afterwards.
Sure. Thanks for all the answers.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Ritesh Shah from Lucky Investment Managers. Please go ahead.
Yeah, hi, this is Pritesh. Couple of questions on the financial business side. First, if you could give 3-year outlook as to how this business should shape up for you, considering the changes which we are seeing over the last 1 year or so on the borrowing mix side, on the portfolio side, and opportunities for growth. If you could spell out some thought process there. And since the whole business is housed under a conglomerate, so internally, what kind of debt equity is generally the group comfortable with?
So as far as we think that the consolidation is taking place in the NBFC sector and only the strong NBFCs will survive. We believe that NBFCs have a very critical role to play in the economy. If you look at it, one of the reasons why the the GDP growth rate in the last quarter has slowed down is because NBFCs did not lend enough. Today, NBFCs are a significant player, and we believe that this space we will be able to have a larger share over time. And therefore, we are confident that we will grow, we'll continue to grow in this space, both in the wholesale as well as retail. Our retail portfolio will increase. The reason why we went into housing finance was our first exposure to retail. Once we've understood this space, we will expand further into other areas of consumer lending as well. Therefore, in the long term, you will find that our exposure to consumer through housing finance and other areas will increase significantly. And our real estate exposure will come down in wholesale. Our exposure to other corporates will also increase in the wholesale space. That's one. The debt equity ratio, we will be conservative. It will be anywhere between 3.5 to 4 in the long term as a maximum.
Okay. Then on the other part of the group, we are housed under, we have about 3-4 businesses. Couple of them, one obviously we have an investment and the other is a healthcare, which at the face of it, at the group, when we do the numbers look ROE dilutive. So any thought process there and any thought process on unlocking the value at the group, via demerger or anything?
So besides the financial services, we have the investment in the Shriram Group, and we have also presence in the pharma space. In the pharma space, you see that our growth rates have been good. We followed a differentiated model. We grew global pharma by 12% last year. We'll continue to grow there. The profitability is going up. It is now at 23% EBITDA margin. On this path, we will continue to do so. As far as the Shriram investment is concerned, we are looking at options how we can maximize value for both Piramal as well as Shriram. So one of the steps that we've initiated is that if we can merge all the Shriram entities into one, the lending entities, the insurance entities, as well as the holding company Shriram Capital. So that is under consideration. We are exploring if there are ways that we can create value by exiting the Shriram Group. If we find the right value, it is possible that we will exit. I think with all this, you will see that the profitability of the overall group will increase. Whether we'll do the split into the business, as I said earlier, in the midterm we will look at that.
And on the healthcare imaging investment of ours?
So the healthcare, we are seeing how we will improve the profitability. The performance, as I said that in my last call as well, is not what we expected, but I see that now there's improvement in the margins going forward. In this year, you'll find that there's an improvement in the operating margins.
Just 2 more questions on the financial side. So we are at about 50,000, 56,000 odd crore book size. A 3-year vision for the group would be what number? And
we are not giving those numbers. So we are not giving those numbers yet.
And what is the provision coverage ratio right now?
224%.
Okay. Thank you, sir, and all the best.
Thank you. The next question is from the line of Ronak Raichura from Asian Markets Securities. Please go ahead.
Yeah. Hello, sir. Thanks for the opportunity. Sir, my question is relating to the ICRA downgrade that has recently happened. Now, in the con call, you just mentioned that your cost of funds are actually likely to get reduced over the next in the next quarter or a couple of quarters. But wouldn't the downgrade actually increase your cost? That is one. And what steps are we taking to actually? The chairman did mention about some possible exit from the Shriram Group as one of the ways. But are we taking any other steps to reduce our debt levels?
So first of all, let me just talk on debt levels. Today also our debt equity ratio is is good. Overall, we have got our debt equity ratio as a company is in the 2.5 range. Even as far as financial services is concerned, we have one of the best balance sheets, and our debt is at a level of 4:1, which is 3.9 actually.
Which will go down in 2 months.
Yeah, as we are now raising tier 2 capital of 1,000 to 1,500 crores. So this the debt equity will go down. So that's one. As far as the ICRA is concerned, the rating still continues to remain as AA+. From a stable rating, they have said negative, and the negative outlook is more because of the industry that we are in, because of the stress you find generally in the NBFC space as well as in the real estate. If you look at the detailed ICRA comments on us, I think they have complimented us on many of the things. To the extent, if I was to read out the promoter group's expertise in real estate segment, the company's risk management and monitoring processes, which enhance its ability to proactively manage the portfolio. They also noted our ability to maintain our capitalization profile, which following a measured growth strategy would remain critical from a credit perspective. So all in all, if you read the overall ICRA report, I think it is negative because of the sector that we are in, but not negative for the company. So therefore, we feel that the cost of funds will come down. Not only will the cost of funds come down, but as Khushru mentioned earlier, we are already seeing that the NIMs have gone up. The rates of interest that we are now charging to our borrowers has gone up, and you will see that effect in the first quarter of the current year itself.
So just to add to what Mr. Piramal said, the proof of the pudding is always in the eating. I can confirm to you that even post the ICRA rating, we continue to borrow at the same low rate. So there has been absolutely no impact. I'm repeating, absolutely no impact in our borrowing program and the cost of funds which we are doing as we speak.
Okay. Okay. Thanks. That will be it, sir. Thanks.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Hi, couple of things. So one, could you share thoughts on progress on creating lines of fee income, which you've talked about in the past, as something which will help ROE in the future?
Yeah, sure. So in fact, there are various lines of fee income. One, if you recollect, we had said that it is again tied up to one more strategy which we had spoken, that we will not have large single borrower exposure on our books in the future, and we had spoken about strategic partnership. So in fact, we are happy to tell you that we have already have 2 now strategic partnership with foreign funds, and you will see us doing this co-investment going forward from this quarter itself, and that will generate fee income. Second, I think we spoke about active downselling. We now have a team in place. In fact, I'm happy to report that in this last quarter, we downsold 1,300 crores of our assets. So again, we generated fee income there. The third is on the corporate finance group side, we had mentioned that we will form an AIF or a joint venture with a pension fund. Again, I think while I cannot divulge the name, we are in advanced stage to finalize an AIF structure where we can again get a lot of fee income. And the last is the asset aggregation platform, which in the next 15 days we will announce with a pension fund, which is almost ready. So I think these are the various streams through which we will be generating fee income. So what we have been saying in the last 6 months, I'm happy to say that we are almost there.
Got it. Thank you. Then a couple of data points. So could you share the amount of total debt at non-financial services? Then within non-financial services at DRG, healthcare, and corporate level?
So the overall debt in overall debt in the pharma is about 4,500 crores. In the DRG business, that's close to about 4,000 crores in DRG as well. So totally about 8,500 crores in the non-FS segment.
Got it. And then Allergan's contribution to the consol PAT, which comes as associate income. In FY18, I believe it was 49.86 crores. Could you share the amount in FY19?
Yeah, it's grown by about 20%.
Got it. And then in 4Q, so if you look at the ROE trend year to date for 3 quarters and then for full year FY19, there has been a move down. So one, as you alluded to, there was a change in NIM, which can change going forward based on the price increases that you've taken. Secondly, is there also a movement in provisions in this, as in provisions higher in 4Q, and if you could quantify the amount over there?
So ROE movement is, if you look at, one is also happening because of the mix change. And as Chairman and Mr. Jijina explained, that there are certain initiatives that you yourself asked on the fee income side that we are working on, and that will sort of bridge the gap of ROE change that is happening because of mix change. You will see that a year back our housing finance book was kind of 1%. Today it's 10% nearly of our total book. And even within the real estate and the other corporate lending book, we are going more granular and we are sort of diversifying and, going towards more lesser risk profile. So from that perspective, obviously to an extent there was a little bit change in the ROE side, but that's where that gap will get bridged through the additional fee income that we create. Yeah.
Okay. Lastly, so in the segmental disclosures that come in the exchange filing, I don't know how significant you would say they are, but in the financial segment, within both the standalone and the consol, declined sequentially. So what is that attributable to?
So that's basically the movement of the loan book which has happened from the standalone to the Piramal Capital and Housing Finance entity.
So the movement of loans from standalone to the housing finance entity caused the decline at the standalone entity.
That's right.
Got it. That helps. Thank you.
Thank you. The next question is from the line of Praful Kumar from Pinpoint Asset Management. Please go ahead.
Good evening, sir, and thanks for the opportunity. Sir, can you comment about the any inorganic acquisitions that you are looking at, and over time, how it will play out for the firm? Will it need more capital upfront for you to do this acquisitions that you are planning?
So first of all, we are not planning any acquisitions. As and when we will have an acquisition, I think we have the ability to raise both capital as well as to have a more credit line. So I think it will depend on what the acquisition is, what is the amount.
Sure. And secondly, sir, I think you have done a great job in segregating 18 accounts and working on those. Just one question: any exits where our own realty company has taken over the projects? Is that also an instance that has that happened? And how many projects are such?
No, we can confirm that not a single account we have transferred to Piramal Realty.
Okay, thank you, sir. Thanks a lot.
Thank you. The next question is from the line of Gopinath from PNR Investments. Please go ahead. Gopinath from PNR Investment, your line is in the talk mode. Please go ahead with your question.
Sorry, ma'am. My question is regarding the exceptional item that we talked about for this quarter. Can you throw some light on that, please?
Yeah, so this exceptional is basically related to a redundancy at our overseas subsidiary. About 77 positions were made redundant as part of the cost rationalization exercise.
Okay. That's it, sir. That's it from myself. Thank you.
Thank you. The next question is from the line of Manan Patel from Equirus Portfolio Managers. Please go ahead.
Thank you for the opportunity and congratulations for good numbers. So my first question is related to the loan book. So basically, if we look at last 2 quarters, our growth quarter on quarter has come down significantly. I understand that the macro environment is such, but is that a conscious call that you have taken, or is the base effect also kicking in for us?
No, I don't think it's the bare effect. We consciously said that at the last quarter, because of general stress in the whole environment, we must be conservative. There is no, we are back onto the growth track, and you will see that in the first quarter of this year, we will show a much better growth rate. So it's just that we were being over conservative, because I think what was important in the last 6 months was to ensure that liquidity is there. If you are a long-term player, it's better to be liquid and not have any stress there. That's the reason.
So just to add to what Mr. Piramal said, I think we have been saying this in the last 6 months, that liquidity is the key, and we have been going all out to get long-term funds. Having said that, if you really dissect our growth, what have we done? It's not that we have not disbursed. We are one of the few NBFCs who have kept our commitment. So if you really look at the disbursement numbers, it was 6,200 crore in the December quarter. It was 5,000 crore in this last quarter. But it was also funded by downselling and repayments, prepayments. In fact, you should be happy that not only we were able to create extra liquidity in our balance sheet through long-term loans, we were able to disburse through also churning the portfolio. So all the concerns have actually got answered in this last 6 months, whether it is the churning of the portfolio, whether we are continuing to disburse, and whether we are able to create long-term liquidity. We have been able to do all the three.
Understood, sir. That's helpful. And my second question is regarding, we have not mentioned, there used to be a page on OTC. It is not there in this presentation. So I just wanted to know what are the numbers for OTC business in this quarter and year.
The numbers we have mentioned in the slide, if you look at, we'll just, yeah. So on page number 40, we mentioned the top line for OTC was 334 crore for the full year and 89 crore for the quarter.
Does that include the JV that we have?
Yes, it does.
So it doesn't include the JV. The JV numbers gets reported as part of the net profit. So there's a direct addition to the net profit that happens.
Okay, so till last year we used to mention that this is consumer products and this is Allergan JV revenue. So I just wanted to know that.
So you can reach out to us separately. We'll get back to you on this.
Thanks a lot. That's it from my side.
Thank you. The next question is from the line of Pritesh Shah from Lucky Investment Managers. Please go ahead.
Yeah, actually I missed the non-financial service debt which you called out, and you split it up in healthcare and pharma. What was the numbers?
It's about 8,500 crores, 4,500 in pharma and the remaining in DRG.
Okay. Thank you, sir.
Thank you. The next question is from the line of Dhawnil Desai from Turtle Capital. Please go ahead.
Hi, sir. 3 questions. So first one is, in absolute terms, our NPA numbers have gone up, and I understand that you are provisioning significantly more than the NPA. So to that extent, on P&L, we have provided more than that. But we have an early warning system by which you identify the accounts in advance where there can be a possibility of stress. So are you seeing kind of more stress coming our way going forward, or you think that we have kind of peaked out on that? That is my first question.
Should I answer that first?
Yeah, sure.
So first to give you the answer, it has actually peaked out. Let me go into a little more granular, as I already mentioned just now. Somebody else also asked this question. So in fact, this NPA has also gone up not because of a lack in our early warning signal. As I mentioned to you, that one of the major additions in this early warning signal was a project from 3C, which contributed 233 crores. Now that project, as we speak, we are curing it, but we had to provide because one of the creditors took the company to NCLT. And that is why we immediately recognized this as an NPA. It was not NPA on our books, but we recognize it because of the NCLT issue, and that is why we are pretty confident that this will get covered. The other addition which came was also, as I mentioned to you, that actually, this 18 accounts which you spoke, one of the things which we discovered that when you work, in fact, it is exactly opposite of what, a lot of times, a lot of investors have asked me that why don't you work with small developers and do more granular? It is actually the opposite. It is when you work with smaller developers and you do a small loan of 50-60 crores, that is where the pain sometimes can be more. And that is why, whether it was SK Group or Jain Heights, we decided that rather than looking at it only for 6 months, why not solve it holistically, take over the assets, recognize it as an NPA, and then solve it. Because as we speak, we are actually solving both. So that has been the reason why we actually added it in our NPA and moved on. So it was a change in the strategy, not that we didn't know or it was not caught on to the early warning signal. So to answer your question, actually it has peaked out.
Okay. Yeah. My second question is, I think as Chairman sir mentioned in his remark, we are expecting 18 to 20% ROE in the financial service business, and we used to do 25% kind of a number earlier. So this change in ROE expectation, is it because of the profile of the book changing, or is there more to read into that?
No, it's really the profile of the book is changing, and therefore as we are going into a more diversified and we are spreading out the risk, this is what will be the long-term profile will be in this 20% range.
And to add, as Chairman had mentioned earlier also, that we would like to maintain leverage at conservative levels. So that is also one of the factors.
Understood. Yeah. And my last question is, in the environment that we are operating in, I'm sure there are a lot of opportunities where, the portfolios are available for sale and probably at a distressed valuation also. So, and those opportunities may be coming our way. So what are the, in terms of framework, what are the things that we may be looking for accepting or rejecting such deals, or are we even open to such opportunities?
So you're right that we are seeing a lot of now portfolios and businesses coming up because of the stress in the system. We are very clear that we will only, we are looking at it, and if we find that the quality of assets are good, the team is good, they have solid systems and processes, and it is at a reasonable value. If all these conditions are satisfied, only then would we look at it. So we are supposed to be aggressive in doing acquisitions, but let me say in the financial services space, we are conservative and will continue to remain that.
Right. Well, I think earlier you had only mentioned that the culture plays a very important role in financial service.
So that's exactly what you're right. Team, systems, processes, that's the thing.
Okay. But we are still open to that, right? I mean, it's not that we will outright do that.
If it satisfies all these criteria, so there won't be that many such assets, but if it does, then yes.
Okay.
And valuations have now become much more reasonable in the last 3 months than what they were earlier. That you will agree.
Okay. Got it. Thanks a lot.
Thank you. The next question is from the line of Utsav Srivastava from Trinetra Investment. Please go ahead.
Hi, my question is regarding the DHFL acquisition. Could you just walk me through as to what the rationale is and where we are in the process of the acquisition right now?
So first of all, don't believe everything that comes in the press. That's my first thing. The second is that we are evaluating on the same criteria I laid out a minute ago, that we will look at some part of a portfolio, not the entire portfolio. We are not looking at investing in the company or in any of the shares. And if we find that the quality is good of its portfolio that we are looking at, if we find that they are following the right systems, processes, if the culture and the team is right, and if it is at a reasonable valuation, and provided that the retail portfolio is what we will do. So if all these are criteria are satisfied, then we will look at it and may do it. But otherwise, nothing more than that.
Great. Thank you.
Thank you. The next question is from the line of Pranav Tendolkar from Rare Enterprise. Please go ahead.
Hi. Thanks a lot. Sir, can you just highlight what are the structured debt part and CFG and ECL part of the total loan portfolio? What are they exactly against? Like, what is the security? What is the structure of portfolio? What is the composition of portfolio structure-wise? Is it promoter loan? Is it project loan? What is these two parts?
So first of all, let me say that if you look at it on a portfolio basis, our structured debt is a minority portfolio compared to in this last few years. What have we done? Let me break it up into various businesses. Business number one, that is real estate wholesale. Now in that, if you recollect, 5 years back, we started with entire structured debt. I think today as we speak, it is, I think, not more than 25 or 30%. I'll just get the exact number. It's actually only 15% of our portfolio. Again, in real estate, I've said this many times, even in our structured debt means what? That when we are funded at the land stage, we have actually cross-collateralized with the mature projects. We never do a pure land funding. It is always cross-collateralized with other projects which are mature for the cash flows, and that is why we have never had a default in structured debt. Let us move to structured debt of CFG, the Corporate Finance Group. Now, those are in the nature of mezzanine deals in the infrastructure and the renewable space, where again we have various structures to ring fence ourselves. So again, we started again in CFG 3 years back with structured debt. Today again, it is less than 50% of it, because we have moved to senior debt and working capital. Talking about emerging corporate lending, it is pure cash based operating. There's not a single structured debt in that. So if I have answered your question.
Right. So this Mitra Energy, that rating downgrade that had happened some days ago, so is that a part of CFG?
Yes, it's a part of CFG.
Okay. And that is the bridge loan that you had provided around 1,800 crores that will be taken over by another.
It's not a bridge loan. It is a long-term loan which is secured by assets and the cash flows and also the shares of the company, and which is what in the papers you are alluding to, which is being taken over by somebody. Yeah.
Right. So another thing in the.
Can we restrict number of questions maybe to 2? I think because there are more participants to close.
Right. Okay, I'll come back if there is time.
Yeah, we can take another question offline.
Thank you. The next question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hello.
Yeah, go ahead, Alpesh.
Yeah, hi. Thanks for taking my question again. Just one clarification. You mentioned that the debt level at Pharma and DRG both put together is 8,500 crores. And when I look at your segmental reporting, the total capital employed is around 12,500 crores into these businesses. So logically, the equity contribution over there is 4,000 crores and 11,000 crores at the NBFC business level. And our net worth at the group level is 27,000 crores. So I'm just trying to reconcile the 12,000 crores number. I believe large chunk of that would be.
You're working to us, and we will help you to understand. Because I don't think we'll be able to understand the numbers how you're trying to explain to us. So you can send us your working, and we'll help you out.
Surely, I'll do that. I'll send that across to you. Thank you. And all the best.
Thank you. The next question is from the line of Kranti Bathini.
We'll take as the last question, operator.
Sure, thank you. The next question is from the line of Kranti Bathini from Wealth Mills Securities. Please go ahead.
Hi, sir. My question is to the chairman. Sir, as your non-compete agreement with Abbott is getting over, what is your plans for again foraying into the pharma space, and how your plans are going to be?
So, as far as pharma space is concerned, we will continue to grow in the existing spaces we are in pharma, As you have seen, we are in global pharma business. We'll continue in that. We will continue in the over-the-counter drug space as well. In addition, we are, and I've said this even in the last couple of calls, that we are looking at the domestic formulations business. If we find some opportunity here, if we will grow through acquisition. If we find something which is of a good value and which we think will create, which will have a growth potential in the future. So we are evaluating. We don't have anything, any specific proposal at the moment.
Are you going with any timeline, sir?
No, we are not bound by any timeline. We are only bound that it should create value.
Okay, sir. Thank you.
Thank you, ladies and gentlemen. That was the last question for today. I now hand the conference over to Mr. Hitesh Tata for closing comments.
Thanks, everyone. In case you have more questions, just feel free to reach out to us and we'll help you to understand better. Thank you.
Thank you. Ladies and gentlemen, on behalf of Piramal Enterprises Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
First of all, don't believe everything that comes in the press. That's my